All right. Good evening, and thank you all for joining us tonight. I just wanted to make sure to remind you guys to keep yourselves on mute until the very end, or if you have any questions, please include them in the chat. And tonight is Brock Collins with Gain Federal Credit Union presenting, and the topic is going to be about budgeting and debt management. So without further ado, Brock, you can go ahead.
Thank you, Liz. I will go ahead and dive right into it. My name is Brock Collins. I'm the Director of Business Development over here at Gain Federal Credit Union in Burbank off Magnolia. And tonight's topic is budgeting and debt management. And I'll go ahead and read the disclaimer for everybody that's out there. This is not intended as legal advice. Materials were prepared by Gain Federal Credit Union staff, although this presentation was prepared with care. It is not designed to be a complete analysis. Moreover, this presentation was prepared with the understanding that it reflects the author's perception of the materials as of this date. In an effort to comply with IRS regulations, we inform you that any tax advice in this communication is not intended to or written to be used and cannot be used for the purpose of avoiding penalties under the Internal Revenue Tax Code or promoting, marketing, or recommending to another party any transaction or matter addressed herein. If you have any specific questions regarding your personal situation, please contact your attorney or tax professional for additional assistance. I apologize, I went through that quickly. So a little bit about me. As I mentioned, the Director of Business Development there. As with the last presentation I did, expectations, if you have anything that you want to hear more about, or you want me to go into depth, please type it into the chat box there. We'll be monitoring that, and if it comes up in the presentation, I'll be happy to elaborate. And then we'll do all the Q&A at the end, as Liz mentioned. And then my contact information, my email and my phone number is listed on the screen there for you. All right, so I will preface the next two slides before we get into them. If you notice the date that these were taken, 2019, they are before the pandemic, so pre-COVID. And the interesting thing here is that financial matters is the top cause of stress for most individuals that are out there. And believe it or not, this is before the economy tanked due to coronavirus. So, 59% financial or money matters challenges. And then the rest, the smaller amounts, the job, the relationships, health concerns, and things like that. And the next slide is very similar. It was just a survey that was taken by bankrate.com. And it talks about how many people could cover a $1,000 emergency and how would they do that. And then to the right there, a reserve report, Federal Reserve report found that 44% of Americans couldn't cover a $400 emergency expense out of their pocket. So this is, you get a flat tire or two and you have to replace them. So essentially we'd have to go into debt for something like that. And then on the left, how would Americans pay for a $1,000 emergency that happened? And luckily 4 out of 10 would actually have that amount in their savings account. However, everything down there below that is paying with a credit card, taking out a personal loan, borrowing from friends or family. And that's still, almost 60% of people that are out there would have to find a creative way to take care of an emergency. And so this is just kind of a basic chart on how we feel about financial health and well-being here at Gain, and that it's not just, a dollars and cents or a number, a bunch of numbers out there. It's actually, there's an emotional component with money, right? Not having the money to pay for things or to see the expenses that are going out. It's an emotional feeling. So we define it as how individuals feel about their money as well as what they do. So what actions are you taking? So you say you want to save for a home or save for a car. Are you actually putting that aside or making that a priority? And so we break down our financial health into these three categories. So the consumption portion, the savings, and the borrowing. And really what it comes down to, the consumption is, are you budgeting, right? Do you have to budget or are you budgeting? Are your bills getting paid on time or are you accumulating late fees and disorganized, so to speak? And then of course, everybody needs a little bit of discretionary money, whether that's going out to eat, going to the movies, buying yourself clothes. if you can take care of the budgeting and you're paying your bills on time and you have extra money, other than savings, you should be using some as discretionary. And then our savings are broke down into short-term goals, long-term goals, and retirement goals. And then the last category of borrowing really is management or debt management. Are you able to pay your bills on time? Are you comfortable? Is it stressing you out? Your credit score, do you have a healthy credit score there? And then again, the types of debt, right? Are you experienced with a credit card, with an auto loan, with a mortgage, things like that? Or have you only experienced a small taste with credit cards? So how much comfort do you have with different types of debt that are out there? And then this is interesting. So when we ask our members out there, why don't you budget? These are some of the answers that we receive. So what we hear is analysis paralysis. So if you hate math and you see a bunch of numbers and you see numbers coming in and numbers going out and it's confusing, and then by the end of a 10-minute session, you just drop the pen and walk away. You just don't even want to look at the numbers anymore. That happens to a lot of people. The second one is pride. A lot of people don't want to do the budget or say they have to budget. They don't want to tie themselves to a spending plan, so to speak. The too hard on ourselves, really that comes down to valuing our self-worth and confusing it with our net worth, right? So what type of clothes I wear or what type of car I drive or how big the house is doesn't necessarily tell you what type of person I am. However, this is a major problem in the area that we live in Southern California, is that a lot of people confuse their self-worth with their net worth. And then there's the I keep track in my head, which is kind of the cipher, I believe it was, from the Matrix, who was sitting there and said, ignorance is bliss, right? If you don't know, then it's great. It's just those numbers are out there. And of course, there's the don't know how. You've never been shown. And that's really what we're here for today. And really, as a resource, if you stop by the branch and talk to somebody, we're here to help you budget, find those categories, find those savings. So what we're going to go over today are some common types of budgets that are used out there. These are 4 of them that we'll go over. We'll go over some debt payment strategies, and then talk about savings rates, and then some resources for you guys. So the first budget that we're going to cover is called the 80-20 budget, and it's very simple. It's 80% goes to all your living expenses and 20% goes to your savings, right? And by savings, that's actually kind of a tricky category because it can go to savings accounts, it can go to retirement goals, it can go to a lot of things like that, but it can also go to your debt management, right? So if you have student loans, if you have auto payments, if you have anything like that, because believe it or not, if you're paying down those balances and that principal, you're still impacting your net worth, your overall worth in a positive way, right? So you want to live off 80% of what you make. You want to save or pay down debt with the other 20. And the big thing here is just cut up those credit cards. You just don't want to build up more debt with this program. This is a very common one that's out there, the 50-30-20 budget. And what it is 50% goes to fixed costs. Now, fixed costs are anything that month in and month out is not going to change, right? So your rent is not going to change, or it shouldn't change usually on a month-to-month basis. So that would go there. Your auto payment, your car loan would go in that category. Any utilities that are fixed would go there. 30% of the costs are flexible. So these vary depending on the month. So sometimes there's an extra week in that month and you need an extra week's worth of groceries. It could be going out to restaurants, entertainment, if there's certain concerts or things that you want to go to. So that 30% kind of lives and breathes within the budget there. And then of course, 20%, you'll notice a theme throughout most of these budgets, 20% goes to saving. That goes to your net worth, paying down debt, whatever. This is a very popular one that's out there as well. It's called the zero-based budget. This is very simple math. You take what's come in and every dollar that you bring in gets a job, right? Whether that's going into your savings account, whether that's paying down a loan, whether that's paying a bill. Every dollar gets a job. And the goal is to have zero in the account at the end, right? So in our example there, we've got $1,000 net. So after taxes that comes in, everything on that list, mortgage, car payment, gym, retirement, savings, everything comes to $900. So the question really at the bottom there, what would you do with that 100? And the answer is actually anything you want. Because if you're able to take care of all your bills, you're able to take care of all your savings needs, and you have $100 left over, you could go spend that. You could save it. You could put it into a retirement account. You could go buy $100 extra groceries. You can do anything you want as long as you get close to zero by the end of the month. And then the last one is really for disciplined people out there. It's the envelope system. It's kind of an old school system there. I'll just explain it. I had a neighbor who actually used this, and he still uses it. It's very successful for him. What he does is every month he goes to the bank and he takes his paycheck and he cashes it, right? There's a certain amount of money that's coming in. He expects that, he knows that. What he does is he creates envelopes. He does it physically, and he'll write mortgage on it. He'll write electricity or whatever utility it is. He'll write groceries. And he knows right around what he spends on certain things throughout the month, like gas and groceries. And he knows what the mortgage and the utilities are. And so what he does is he'll round up slightly and put that amount in the envelope. Now, the key to this, that last bullet point, once the funds run out, that expense is done for the month. This is why it's for disciplined savers, is because if you use your grocery budget 3 weeks into the month, what are you doing, you think, with that last week? Well, you can't pull from other envelopes. So you're eating mac and cheese and beans and rice for the last week of the month, right? You're not supposed to take funds out of different envelopes. And then, of course, we've all heard of the pay yourself rule. And it's based off, savings goal or percentage, like it says. But really what you want to do is you want to make yourself a bill. So in my case, Brock is a bill every month. And what that means is I want to make sure Brock gets paid before all the other bills get paid. So this can be as easy as setting up an automated transfer to a 401k or a savings account or something like that. And so if you calculate, to hit my savings goal, I need to save $500 a month. You want that to automatically come out when that paycheck hits so you don't catch it, right? You don't want to touch it because money that goes through your hands tends to stick there and you tend to spend it. So that's why the key at that last bullet point is really to automate these things. And finding ways to decrease fixed expenses is kind of an interesting one. This is contacting your internet, TV, cell phone provider, seeing if you can bundle certain expenses, seeing if you're eligible for another 2-year plan on your cell phone that might decrease the monthly amount. It's finding all these little nuggets of money laying around that you might have been automatically paying every month, and you want to decrease those expenses or negotiate with that merchant. All right, so savings goals, we have what's called an emergency savings. And emergency savings, typically, we covered before, is anywhere between 3 to 6 months of living expenses. So if all your living expenses total, $5,000 a month, let's say, you want to have a minimum of 15 up to 30 in this account. And believe it or not, after the pandemic, a lot of people thought that they could actually have a larger emergency savings. So some people have a goal now of 9 months of emergency savings or 12 months, or, it's whatever you're comfortable with, whatever helps you sleep at night. And depending on how many incomes are coming into the household and the job stability, you may feel comfortable on the 3-month side. So it just depends, and it varies person to person. And then again, these are national averages. So a short-term goal is anything that's 6 months to 2 years, down payment on a vehicle, vacations, things like that. Where midterm, we typically classify as 2 to 6 years. And I say national standards because sometimes saving for a down payment here in Los Angeles can sometimes take more than the 2-year mark, right? And then long-term goals, we've got everything from retirement, college savings, weddings, things like that. These are big goals that are years and years and years out for you, but you still want to plan and you still want to put a little bit away from today so that you're not rushing at the end. And then for anybody that's heard of a true savings rate, the calculation, I just want to give this to everybody. I'm not going to get into depth with this, but when somebody talks about their true savings rate, this is what they're talking about. So all their savings, this is their retirement, their savings accounts, college accounts, anything that they're saving divided by their net income. And this gives you a percentage. And it's kind of fun to play around with because some people say, oh, I'm saving 1%. And some people you'll hear 20%. And there's all kinds of different percentages depending on what your goal is long term. And then a big one that comes up here in the financial industry is good debt versus bad debt. So what's good debt? What's bad debt? Obviously a mortgage we look at as good debt, right? Especially with the way the home prices are going in California right now. It's kind of crazy, but it's one of the #1 wealth builders in this country. And so a mortgage can be looked at as good debt. Student loans can be looked at as good debt, right? Because technically you're investing back into yourself. And what that should allow you to do is to technically charge a higher premium or salary. So student debt is typically looked at as good debt, depending on how much you actually spend for that degree and the demand for that degree. And then there's bad debt that's out there. We want to keep people away from payday lenders and really overusing credit cards, things like that. But if you're using a credit card, collecting points and paying it off every month, you're not doing any harm to yourself. So it just really depends on what the use is of the debt and do you really have control of it. And we're going to go through a couple of ways to pay it off. This is called the debt snowball. And what this is if you have multiple debts, credit cards, auto loans, things like that, you're going to make the minimum payments to all of them. But if you have extra money after those payments, all that extra money is going to go to the smallest balance. So what this does is this really wins a psychological warfare in your mind. So what's going to happen is you're going to see that smallest balance disappear first. This is the one that motivates people to pay off debt. And so the example that you have here, you've got balances of $1,000, $800, $2,500 to American Bank, Wells Dry Bank and Trust, and Chase Out of Town Card Services. You've got the APRs or the interest rates, and then the minimum payments that are required. Now, if you have $300 at the end of the month to make payments, you're going to make all those minimums, the $25, the $100. But the one with the smallest balance, the Wells Dry Bank at $800, you're going to pay $175. So you're going to pay over the minimum to start decreasing that and kind of get that off your books as quickly as possible. Now, this isn't going to save you the most money because you're not attacking the highest interest rate, but it's going to keep you going and keep you motivated to knock out these debts. Versus the next one, which is called the debt avalanche. You have the exact same scenario, but mathematically, this is going to save you the most interest over time. And what you're going to do with this one is you're going to attack the one with the biggest interest rate with the additional money. So you have the exact same scenario here of the minimum payments of $25, $80, and $100. Still, you have $300 at the end of the month to make payments. So guess what? You're going to pay the 25, the 80, and the one with $100 on your screen there has the highest APR or interest rate at 17.99. So you're going to pay the extra money on top of the minimum payment there. This is called the debt avalanche. And then the one-time large impact. This is an interesting one because we often see this when somebody makes a splurge and goes out there and buys something that they shouldn't. So Brock goes out there and shows up in my new Tesla that I can't afford. So the biggest impact I could have on my debt is to go right around, turn it in, and get something that's affordable for me, right? So some people will look at this and they'll sell their baseball cards, or they'll sell their comic book collection, or whatever it is, and they'll take that money and they'll pay it to the debt that's keeping them up at night. And essentially what you want to do is just get that payment, get that whole thing out of your life as quickly as possible. And again, we see this all the time with splurges at the credit union. And then we've got some software and apps for everybody here. So gainfcu.com, no cost for our members, has a lot of tools. And then some of these personal capital, Quicken, YNAB stands for You Need a Budget, Mint. And so the ones that are free are listed there. And then Quicken and I believe YNAB have a monthly fee or a cost. Quicken, I believe it's yearly, and YNAB is monthly, but they're good programs for people, and they typically save people money with their budgeting. And then a nice resource out there for anybody that has children or teens. If you go to gainfcu.com, you can look at our Independent Advantage program, which is financial literacy for teens between the ages of 14 and 19. We do this in person, but over the last year, we've actually been doing it through virtual means for the students because of the pandemic. But once that comes back into person, we'll actually offer both. And it's a 4-week program. When it's in person, it's 2 hours a week, one time a week. And they come in and they learn about the products, checking and savings and their checkbook and balancing and things like that. A week on budgeting. There's a week on understanding credit scores and how those are used responsibly. And then an electronic access night, which is hands-on. They get to go to the ATM and withdraw $20, put it back in. They get on a computer and set up their online banking. Then they do their mobile. So it's very hands-on, and it's really meant to give them an initial taste of what actual banking is, so that your teen is not making a lot of the mistakes that we did because we didn't have financial literacy a long time ago. And then that'll conclude the presentation. If anybody has questions, I'm going to go ahead and answer them now for what's in the chat, or if anybody wants to unmute themselves. And then, of course, if you want, you can always send me an email or contact me. That's my direct extension. So let me see here. And Lisa, do we have any questions there?
Yeah, I have Jeffrey. He just got in a few minutes ago. I believe he's asking if we already went over budgeting. So yes, we did.
Oh, yes. Sorry, Jeffrey. Did I talk too fast?
Oh, I think he got kicked
Quick
out.
presenter.
Anybody else have any questions?
Any questions on budgeting or debt or anything?
Yeah, I'm sorry. Did you already go over the budget? I'm sorry, I came in a little bit late. My name is Jeffrey Lopez, and I don't know what you went over in terms of budget. I apologize if this is a repeat for some.
No, that's not a problem, Jeffrey. I went through the presentation fairly quickly tonight. We went over certain types of budgets, the most common ones that are out there. So we touched on the 80-20, the 50-30-20, the envelope system. Those were the three main ones that we
I'm
went
sorry,
over.
those budgets that you speak of, you know, I'm not sure if we're talking about the same thing. When I was thinking about budgeting, I'm thinking of like a household of like what we spend on on a typical, paycheck every 2 weeks, like food, miscellaneous household things for the kids. Is the budget that you described, is it similar to like households, and like, does it break it down as to like, that type of like expenses on
No,
week?
this was just a high level overview of the types of budgets that are out there, and what fixed expenses versus flexible expenses mean and things like that. I do have some of those resources here at the credit union that talk about what you're asking about is recommended percentages for certain categories of spending. And I can get those to Lisa if you want. I have a worksheet on that.
Oh yeah, that would be helpful, just because I know that, this whole pandemic thing, my wife doesn't have health insurance, and I've been very like proactive in terms of like trying to get healthier food in the home. So I have been buying and spending more on organic food, doing a proactive in terms of her not having health insurance, just, preventative care with good food, good supplements, and just, things like that. And I've seen that the budget has increased due to, organic does cost more, and
I hear you, Jeffrey. I am doing the exact same thing. So my wife and I decided to use the last few months when everything was shut down as kind of a health kind of reset. So dieting, everything has been organic in our house, and a lot of weight loss and all kinds of things that are going on. And yes, you will see that grocery bill creep up.
yeah, no, it's gone up quite significantly that I'm like, man, dude, so I need to get a higher paying job or I need to figure out how this works. But yeah, as you know, you do pay more money for good quality food. And again, with the whole pandemic, just trying to be preventative care and try to put more, valuable nutrients in our body is it's expensive, it's pricey.
Yeah, a lot of it comes down to meal planning. If you can plan what you're going to eat and you can prepare it yourself and it's healthier, sometimes at least you can get the proportions a little bit closer and save money on at least not wasting the food and throwing it away and things.
Yeah, for sure. Yeah, no, we've been buying books on like, cookbooks and how to meal prep like certain type of foods for the whole week. Um, but I got a wife and I got three little kids and everybody's trying to, do that preventative care. And again, for my wife mostly, she doesn't have health insurance. So for her and for me, myself and the family, just yeah. So that's why I thought when you were talking about budgeting, I thought you were referring to like paycheck to paycheck, like, but it might be a little bit different. But yeah, if you have anything, yeah, please share it.
Yeah, I have a worksheet that I can send to Lisa.
So Camille has a question. She is asking, what if you don't have funds left at the end of the month? That's my challenge.
If you don't have funds left at the end of the month, I would say there's a couple of things you can do, Camille. Number one, like was mentioned, I believe on one of the slides, is you can attempt to, let's see here, decrease expenses, right? You can try to renegotiate some of the bills that are in the house, whether it's calling your like credit card provider and trying to get a lower interest rate and payment. You can, one thing you could do is, depending on the amount of debt that you have, is look for some type of consolidation loan to pull all, two or three of these things and put them into one payment and stretch it out. And what you can do with the consolidation loan is you can stretch it out rather than a year or two paying it back. You stretch it out to 5 years, and that can give you some breathing room. Otherwise, the hot topic out there nowadays is a side hustle. So if there's any way that you can make money separately, doing something that you like to do that you wouldn't even consider work on the side, that's really the best thing you can do on weekends and nights. Otherwise, I have a lot of friends that are delivering for some of the DoorDash, some of the food apps and things like that. And they're just doing a couple hours a week, but they're making money doing that. So there's really a lot of ways to make additional money. It just depends if you have the time and the energy after the day.
Okay, so Erica and Evelyn both have a similar question. Erica was asking, does GAIN offer debt consolidation?
Yes, we do.
Okay, and
We have
Evelyn
a loan.
Evelyn was asking if there's a debt consolidation organization you would recommend.
An organization. So we can do a debt consolidation loan here, but at certain times we will refer our members out to have a conversation with what they call like a credit counselor or a debt counselor with, I believe it's Balance might be the company. I'd have to check, but I think it's Balance from what I remember. And so we'll use any kind of resources that we have to kind of pair with our products to help our members. So it just depends on what you need.
Does anybody else have any other questions?
Hey, Lisa, can I say something?
Yes, ma'am. Go ahead.
Believe me, I've been through all this stuff you guys are saying, but the one thing I really want to stress to everyone is don't go to a company that says they can consolidate your debt. I would rather go to my credit union or to my own bank to get those consolidation loans, because like Cash Call, for an example, I don't know if you guys ever heard about that, but I used to do that a long time ago. And unfortunately, I learned the hard way how much they actually do charge. And thank God, after a few years, I was able to get a legitimate loan from my credit union to pay off that debt. And then I paid off the debt from that within a year. Because
Now,
basically the interest rate.
I was going to say Cash Call, aren't they considered more of a payday lender?
Yes, but they give you quite a bit of money.
Stay away.
Yeah, so
Run.
yes, I want to make sure people realize, do not go to those type of companies. It's safer to do your credit union, and I trust the credit union 100%. I have 2 credit union accounts right now, and they've been a godsend in terms of when like my car broke down and I had the credit to pay it, but then it's like, well, I'm not going to pay 27% for the repair, so I got a loan afterwards. But because of the situation, my car repair, I had to do something really fast, and then I got a loan to pay off that debt, and then I just paid off the debt to the credit union.
Yeah, I'm not going to say all payday lenders are bad, but I'm going to give a heads up to everybody out there. Just like Vivian said, the interest rate is usually,
Ridiculous.
I'm going to say 5 to 10 times higher than your credit union, for one. And then 2, a lot of times what we've noticed, what I've noticed with members throughout my financial career, even when I was in banks or credit unions, is they'll have you sign a document that says they can take the money out of your account monthly. But here's the thing, if you don't make the payment, or if you miss that date, or they just feel like taking the money out of your account on a specific date, they will automatically deduct it from your account, which can throw you into the negative. And they have no remorse for it. And I just don't understand why a lot of these companies are really still in business. It's kind of scary what I've seen.
I was gonna say something to add to that. Did you say, and Vivian and Brock, you were saying about the big banks? Because I know, like before the whole recession back in 2007, a lot of big banks like Bank of America, Chase, and I know I had Bank of America. However, after the recession, a lot of people pulled their money out of the big banks and went to the credit unions because it just seemed like they were fair in terms of the way they were treating people, treating families, and a lot of big banks like my bank, wouldn't negotiate with a lot of families, wouldn't refinance, and it didn't affect me, but I pulled my bank out of that Bank of America because I didn't like the way they were treating others, and I went to a California credit union. And did you say, Brock, that credit unions do provide lower interest rates for like car loans or other things, as opposed to the bigger banks like Bank of America and Chase? Is that what you said?
I didn't say that, but that's absolutely true. So the way it works is credit unions are actually not for profit versus your large financial institution. And I'll preface everything I'm going to say as I've worked for the big banks in the past as well. So I've been in the financial field for just over 16, almost 17 years. And I've worked for 2 of those larger banks you mentioned, as well as 2 credit unions as well. So I know the culture and the environment, which is very different between a bank and a credit union, which is why I like credit unions so much. But what it is because those banks are for profit, you're technically a customer. So when you sign up as a customer at a bank, you're agreeing to terms, right? That's that signature card that they have you sign. We have one too, but it's a little bit different. And so what it is they'll require you, like for instance, with Bank of America or Chase, to have a minimum balance in that account, right? To avoid fees. Or they'll require you to have a $500 direct deposit to avoid a monthly charge. That's one way. So for instance, our checking account has no monthly fee and no minimum balance. So you can literally leave $5 in there and you're not going to get charged. Because we're not for profit, we're not trying to gouge our members with costs and things like that. So a lot of savings goes back to our membership. It's more of a cooperative philosophy. And then as far as auto loans go, there's just a big philosophical difference on how to charge that interest. So like a big bank, if you buy a new car, you're eligible for what they call their prime rate or their best rate that they're offering. Every year that car or that auto gets older, they will tack on more interest onto the minimum interest that they can charge you. So if it's a 1-year-old car, it's going to be 25 basis points or 0.25% more than what their best rate is. If it's 2 years, it might be 50%. And so for every year, they'll charge more interest. And then they have a cap usually of, we won't touch a car that's older than 5 years or 6 years or something like that. Whereas credit unions will usually go, they'll go for a much older vehicle. And then for instance, our new and used up to a certain age, a couple years, they're both eligible for that prime rate. So it's really just a difference in business practice and what you're trying to raise money for. You got to remember, the for-profit institutions are trying to raise money for shareholders in general. So hopefully that answers a little bit about the difference between a bank and a credit union.
Yes, yeah, thank you. Good to know. Good to know. Yeah, I had a California credit union and I had a car loan and it was 1.9%. This was a few years back. Can't remember when, but it just stayed that way until it was paid in full. And 1.9 is pretty good, being fixed and not, increasing with time. So, but thank you, bro.
Okay. Erica has a question. She wants to know what credit score is needed to get debt consolidation loan or to get a debt consolidation loan.
Oh boy. I don't know that specifically off the top of my head. I'd have to check with my lending department for the credit score. I mean, I would just say as long as it's an average credit score, you'll probably be able to do it. But remember, they're going to look at income, credit, and then the amount of the total debt. So they're going to look at 3 to 4 things there as a whole picture. So it's hard to say exactly, right? So if you have a very high income, but you have a low credit score, you still may qualify, versus if you have a lower income and an extremely high credit score, you may qualify. So it just depends. Erica, what I would say is if you have a specific question in regards to your debt or the amount, either contact Lisa or my email address, I think was on that previous slide. Just shoot me an email, and what I'll do is I'll run that scenario by our consumer lending team, and they can give you a specific answer.
Okay. And Camille has another question. What is the most common monthly mistake that many of us make that we can easily correct?
That's a good question.
The most common monthly mistake we can easily correct. That's a tough one because I want to say there's a couple. The first one really is a lot of people fail to budget. So just having a budget written out already puts you ahead of the curve. I think it's like 30% of people or 40% of people actually have a written budget. Everybody else just kind of spends freely. And I think a budget kind of holds you accountable to what your goals are. So there's a couple of things. I would say number one, have a written budget. That's a mistake you can correct yourself and you have control over. Number two, the pay yourself first thing. I'm passionate about that because you need to be putting money aside for yourself, whether that's retirement or an emergency fund. We all saw the importance of emergency funds as this pandemic rolled out, right? People lost their job. People got diminished hours at work or diminished pay. There's been all sorts of financial hardships all over the place. So I think paying yourself first and prioritizing your savings and your goals, take care of yourself, whether that's financially or mentally, health-wise, is very important. Those are really the things that I'd like to pass on to people.
Does anybody else have any other questions?
No, I was just gonna share on that when you say the budget, my wife and I, we listened to Dave Ramsey. We had a book, that some friends of a friend gave to us, and he had some podcasts. I mean, he does all this financial stuff. And he has this cash system that, it might be helpful for some people, where you and your spouse, whoever's, the income, earning the income, whether it's the two parents, sit down, come up with the budget, and we take it out cash. And, my wife, she does the grocery shopping and she's responsible for some of it. And then I'm in charge of like the eating out money, and whatever the cash is, that's what we take out, and that's what we try to use for the 2 weeks until the next payday.
That's
It's
the
kind of like just
envelope
like-
system, right?
Yeah, that's right. Yep, the envelope system. Yeah,
We did go over that.
Oh, did you? Darn it.
Yes.
Okay, yeah. Well, all right. Well, I'm just
No, and
reiterating.
I'm
it.
very familiar with Dave Ramsey. There's a
Yeah,
lot
yeah.
of good. There's a lot of good financial gurus, as I call them, out there. I
Yeah,
mean,
you
Dave
can YouTube
Ramsey's
some of them,
great.
Yeah.
If you listen to podcasts, there's one called Stacking Benjamins, which is really great. There's Afford Anything by Paula Pant. I could recommend 4 or 5 of them that are actually really good, depending on what you want. Some of them specialize in budgeting, some of them specialize in debt, really paying down debt, which is what Dave Ramsey really is passionate about. Some of them are regarding investing or retirement. So depending on what the topic is, there's a lot of them out there.
Yeah. Well, the cash system does work. My wife and I, we just have to like retweak, with the organic food. We've been spending more. So we have to retweak our budget for food and stuff, because it does cost more, as you know, to buy organic. But I'm glad you touched on that cash system. Yep.
Okay, so if nobody else has any questions, I guess this will conclude our session for tonight. I want to thank Brock again for joining us, and also for GAIN Federal Credit Union for providing the funds for the opportunity drawing that you guys have entered in. And yeah, if you guys have any questions in regards to anything that was discussed tonight, just feel free to email me and I'll relay them to Brock. And if you want, you guys can join us next week again for Money Matters. And it's going to be Brian Schwartz this time around, our financial advisor. And if you guys have any other questions, reach out to me. You guys have my email. All right.
You asked for it,
Thank
Lisa.
Thank you.
All right. Thank you
you.
guys. Have a wonderful night. Thank you.
Everyone.
Bye.